Hi, welcome to the LIVgreat Podcast, where we talk about all things real estate and local community in Southeast Michigan. I'm Diane Crouch, and I'm your host for today. And today we're joined by Mark Copland, and we're going to talk about one of the most important things in the buying process, and that is lending and getting your pre-approval so you can actually buy your dream home. So welcome, and thanks for joining us, Mark.
Thank you. Great to be here. Appreciate it.
Very welcome. So Mark, you are with Total Home Lending. Tell us a little bit about your background and how you got started in lending.
Well, let's jump back 24 years because that's how long I've been doing this. I was selling cars. Doing very well at it. I've been doing that for about 8 years. Had 2 young kids and had recently divorced. I sold a car to a realtor who liked the way I did things and explained things and the financing options and stuff like that. And she suggested that hey, if I wanted a little more free time and not have to be sitting at a desk, because in the car business you're there probably 50-60 hours a week.
Yeah.
Just you got to be there to get the business. So she said, hey, if you want a little bit of flex time and maybe something a little different, you might want to try mortgages. It seems like you'd be good at that. So on December 7th, 24 years ago, I took the leap. I jumped into mortgages, and it's been fantastic. First few years of anything, doing it when you're brand new, lots to learn. In our business, a lot of what we learn is it's on the job training.
Yeah.
You don't learn it from a book. You learn it from bumping into it, and that's why those years and years of experience are very helpful to guide clients the right way, the right direction for things to do, and make sure that I've got their best interests in mind. But that's how I got into it.
Very cool. So tell me, you said guide clients in the right way. What do you think sets you apart and sets how you work with clients and guide clients? How are you different than other lenders?
Yeah. Well, all of us can say, hey, this is our rate today. That's easy. I tried. I don't like to use the word concierge too much, but that's kind of the approach that I've wound up taking. Is I don't hand people off to 3 or 4 other people. I've got a team that works behind me that does help me do what I do, but up front, I'm the one that's working with the client. I'm the one that's pricing homes out for them, unless I'm out and my assistant can help with that stuff when I'm not available. One of the things I think that sets me apart from other lenders is the accuracy of my estimates. I look up property taxes.
Yeah.
I use reasonable estimates for budgets for homeowners insurance. My cash to close is probably going to be worst case, not best case. I see a lot of lenders. I see a lot of worksheets from other lenders that I consider sloppy. Where they didn't look up property taxes, they just threw a number in there.
Yeah.
They're using some really low number. We all know homeowners insurance premiums have gone up recently, and they're using lower numbers for homeowners insurance that aren't realistic. So I like to plan for the worst.
Right.
And then everybody's happy at the end when the cash to close is lower, the payment's lower, everything else. One of the big things, the other big thing that I do for my clients is I estimate future taxes. Education, right? Letting them know what's going to happen in Michigan when the cap comes off the current owner's taxable value because of a sale.
Right.
Those taxes could go up a little bit if that owner's only owned the house a year or two, or they could go up a lot if that owner's owned the house for 10 or 15 or 20 years.
Okay.
So knowing what payment they have to budget for next year when that cap comes off the taxes is really important. And I've talked to other lenders, other loan officers. It is very rare that people actually put a number on it. They'll warn people that it's going to happen, but they don't put a number on it. And one final thing that I do is I invite all of my clients, when they buy a house this year, to put a note on their calendar for March 1st of next year to send me the notice of taxable value that comes in the mail. That way, I have an accurate number. I can tell them how to plan ahead and make sure they've got enough money to put in that escrow account next year so it doesn't go short.
Okay. So you're saying that when buyers look at how much it's going to cost them, they see a home, they put an offer in, They work with their loan officer and they come up with an estimate of what their mortgage is going to be per month. And you're saying oftentimes the lender doesn't calculate or doesn't share with the buyer what the new monthly rate will be once the taxes are reevaluated the following
Right.
year.
Yeah, and that can be a big surprise. And the problem with it is, fast forward 2 years. So if someone doesn't talk to a lender like me that goes into that future tax and give them that budget amount, a worst case number for them to plan on for taxes next year, for instance, let's just say the taxes are going up $3,600 next year, which is not uncommon.
Right.
If the taxes go up $3,600, they have to know that the payment they're looking at today on their closing documents is not the payment they're going to pay next year.
Right.
They want to budget for a payment that's $300 a month higher than what shows on that paperwork. And a lot of lenders don't give them that information. So especially for first-time buyers,
Yeah.
and people that are really on a budget. For someone buying a $500,000, $600,000, $700,000 home, a lot of times they're not stretching themselves thin on their budget. So they've got that extra money to be able to pay those shortages off, and it's not that big a deal. But when you get into $150,000, $250,000 homes,
Yeah.
a lot of times these people are on a budget,
Right.
and they can't afford that payment to be $300 a month higher. And I've had some people say, well, I can't make that payment. And I'm like, well, you have to look at a less expensive home then.
Right.
And that's really part of the process, is making sure that they're in a comfortable area for a payment for them, cash to close, and a payment that they're going to be comfortable with going forward, knowing all the information, because we know it's going to happen.
Right.
We know the cap's going to come off the taxes. Why don't people talk about it? I know most realtors talk about it.
Yes.
But lenders, we're the ones running the numbers.
Right.
We should be giving them that information as well.
Yeah, it's definitely important. Like you say, if somebody is kind of tight on their budget, a couple of $100 makes all the difference in the world.
Yeah.
So you need to know that going in, that change is going to happen within the next year. So.
And one more thing on that is, if they aren't prepared for it, if they don't send me that notice of taxable value that comes in the mail next year, and start to pay the higher amount into their escrow account manually, because we know what the taxes are going to be. If they don't do that, then 2 years from now, the payment won't go up $300. It's going to go up $600 for 12 months, because they have a $3,600 shortage that they have to repay the lender for that. There's no penalties or interest for having the shortage, but they do have to repay the lender.
Yeah.
So they'll spread that out over 12 months at $300 a month. But now we know that now the lender knows, or the loan servicing company knows, that the taxes are higher. So they have to raise the payment $300 a month to make sure the escrow account's not short going forward. So you have a $300 a month to repay, and then that goes away in 12 months. But still, that big increase for that 12 months, 2 years from now, a lot of people can have made changes. Maybe they went out and bought a car because they got used to this mortgage payment. They said, I've got excess money, I can go buy a car.
Right.
And then 2 years from now, they get that big bill, that big increase in payment, and it can be stressful and very hard on the budget. Lenders don't want to cause any problems with people. So if that huge increase in payment is trouble, they will spread that shortage out for a much, much longer time. So it's not something I want people really freaking out too much about, but planning ahead avoids those headaches later.
Yeah, like you say, it's just education, knowing ahead of time what to expect, and then making plans accordingly.
Yeah.
So exactly. So mortgage rates have been a big. They're always big in the news, but just over the last few days specifically, interest rates have been in the news, and how those changes or the drop in the interest rate may affect the mortgage rate. What can you tell us about that?
Okay. And I've had that discussion the last couple of days. Every time the Fed meets and has a policy decision. So the Federal Reserve yesterday lowered the Fed funds rate 25 basis points, or 0.25. That does not impact mortgage rates directly. Our rates actually went up a little bit just from yesterday to today. Mortgage rates are dictated by the buying and selling of mortgage bonds. Think of it kind of like stocks. And the interest rates that come out, the interest rates that we have from the buying and selling, are dictated by how the markets react to what the Federal Reserve does. And yesterday in particular, the markets initially reacted great. to the quarter point. The bond market went up, meaning the price of the bond goes up, the interest rates come down. So the bond seemed to like it was going to rally, and we were going to get a little bit better rates during the day. And then Jerome Powell started to speak, and he was a little hawkish, meaning I'm still going to be cautious. I'm not promising 2 more rate cuts this year. I'm not promising rate cuts next year. The markets like to be able to plan ahead. And if they can't plan ahead, then they're going to hedge their bets. And that's kind of what happened was the markets pulled back a little bit. The bond market, the stock markets were kind of mixed yesterday, but not really that worse. It's not like we got a lot worse. It just wasn't that things improved. So the big misconception is that the Federal Reserve controls mortgage rates.
Right.
And when the Federal Reserve increases or drops their rate, that directly impacts mortgage rates. And that's not true. It's how the markets react to what the Federal Reserve does is what dictates mortgage interest rates.
Okay. So where are the interest rates now? And I know I've had a lot of buyers saying they're expected to fall within the next few months. Is that something that you're anticipating? I know you don't have a crystal ball.
Yeah, I wish I did.
You can't always tell.
Right.
What do you say to buyers who ask you that question?
Right. When when people ask me what's your interest rate, because I get that a lot when people call, hey, what's your interest rate today? I'm like, okay, well, what's your credit score?
Yes.
What's your purchase price? How much do you put down? What's your income? And not only what your income, what's your household income?
Yes.
So there's so many different programs available. What's your profession? So there's so many different programs available that we can look at that might give them a better interest rate, might qualify them for a better interest rate. If someone's income is under 80% of the area median income, and that changes by county,
Yes.
happens to be very high in Washtenaw County, the area median income. But if someone's income is under 80% of the area median income, and let's say they have a 700 credit score, they're going to get the same interest rate or better interest rate than somebody with a 780 credit score, because there are special programs out there in place to offer better interest rates for people that are lower on the income scale.
Okay.
So there's a lot of information. It's hard to say, hey, this is what the rate is.
Yeah. So it's totally, it varies a lot according to several different factors.
Yeah.
No
And person to person.
set amount.
Mm-mm.
Because I think that's often a misconception.
Yeah.
It's 6.25 or it's 6.75, whatever it is. I think people think it's a set amount no matter what.
It used to be.
Okay.
It used to be. When I got into this business, it didn't matter what your credit score was.
Yeah.
If you qualified,
Yeah.
that was the rate you were going to get.
Mm-hmm.
And then eventually, I can't remember what year, they all blend together. Fannie Mae and Freddie Mac went to risk-based pricing, which means lower credit scores pay a higher interest rate than higher credit scores.
Okay.
More down payment, meaning 25% or more gets a little better interest rate than 20% down.
Okay.
So,
It just varies.
it just varies. The only one that is the same for everyone that qualifies is the state bond program. So Michigan State Housing Development Authority, MISHDA, MSHDA, they offer a 6.625 interest rate for people that qualify for and need a $10,000 down payment assistance.
Okay.
Then, and that's just anybody over a 640 credit score. You're going to get that rate. It doesn't matter. They also offer a 6% interest rate right now for anyone that does not need down payment assistance, but does qualify for their program. So that's income-based debt to income ratio. So we look at that. So just one of the loan products that we look at for people when they apply, what they qualify for, where can we get them their best deal?
Okay, so in addition to that MISHDA program, what other programs should people be thinking about and what can you offer them?
We've got every program out there available, with the exception of a full construction loan program.
Okay.
But we've got a couple of great doctor loan programs, zero down, no mortgage insurance, and loan amounts up to $1 million something. And we also get to treat their student loans differently than a regular conventional mortgage.
Okay.
So a lot of doctors graduate with $200,000, $100,000, $200,000 in student loans. In order to them to qualify for a house, most of them on their student loans, their payments are going to be virtually nothing,
Right.
just because of what they're making starting out. So we get to treat those student loans a little differently than we would for a conventional mortgage. We've got special loan products for teachers, for first responders, with lower down payments, 5% down, no mortgage insurance, and engineers. So there's lots of different programs depending on, once again, kind of similar to interest rates.
Right.
Depends on what you do, what your credit score is, what your income is.
Yeah.
And we look at everything we have when someone applies. We look at everything we have to try and say, hey, this is going to be the best option, or here's 2 or 3 different options that we should look at for you, and you pick the best one that's going to fit your needs.
Okay. Great. I've also heard people talking about buy downs, like 2-1 buy downs. Can you explain that, what that is, and when that would make sense to use those?
It's 2-1 buy downs are really a tough one. They were popularized again. They've been around a long time, but they were popularized again when rates were really high in the high sevens, and it was a way for lenders or sellers, because the buyer can't pay for it. It doesn't make sense for them to pay for it.
Right.
The lender can pay for it, or the seller can pay for it. And it's a way for that buyer to get an effective lower payment for the first 1 year, 2 year, 3 years. So it's a 1-1 buy down. It's based on a 1% lower interest rate for the first year. 2-1 is 2% lower interest rate for the first year, 1% for the second year. 3-1 is a 3-2-1, 3% the first year, 2% the second year, 1% the third year. The interest rate on that mortgage does not change.
Okay.
So if you start out at a 6.5 rate and you do a 1-1 buy down, your first year payment for you will look like it's at 5.5%, but that extra 1%, the difference in payment between the 5.5 and the 6.5, is being paid by the lender or the seller.
Okay.
So your mortgage statement, when you get the mortgage statement in the mail with a buy down on it, it's going to show that 6.5 interest rate, and then it's going to show a credit
Yes.
on every month for the amount that the seller or the lender paid on your behalf. That money basically is a lump sum of money that goes in a bank account, so to speak, at the loan servicing company. When you pay off that mortgage, so let's say you do a 1-1 buy down and you pay off that mortgage in 6 months, the rest of the 6 months gets credited towards your payoff, so you don't lose the money.
Okay.
That is kind of a neat thing about the buy downs. We haven't seen a lot of them. A lot of the reason we haven't seen a lot of them is, in order for a lender to pay for the buy down, they have to increase your interest rate.
Okay.
I can't give you the very best interest rate and then pay for a 1-year buy down. You just can't do it. Financially, we can't do it.
Yeah.
I know lenders are out there advertising it and things like that, but when people get quotes from those lenders, they'll see that the interest rate without the buy down is lower than the interest rate with the buy down.
Right.
And that interest rate is for 30 years if you never refinance.
Yeah.
So that interest rate's higher forever. In that case, the lender would make out if you never refinance, right? If rates never came down and you never refinance, then the lender would make out on that. The other reason is competition. We're in Washtenaw County, and competition here is still pretty fierce. I work all throughout Michigan, so I see what's going on everywhere. So there are areas where competition's not as fierce. We see sellers offering concessions or our buyers with FHA mortgages, VA mortgages, or down payment assistance not having as much trouble in certain areas getting their offer accepted.
Right.
But in Washtenaw County, it's still pretty tough. It's still pretty competitive. When you have a highly competitive market, the sellers aren't going to contribute and give you money to do a buy down.
Right.
The other thing that I see with buy downs is a buyer would most likely rather have that money as a concession
Yes.
than a buy down.
Okay.
Why save a little bit every month when I can get that chunk today, that lump sum today, to lower my cash to close today?
Right.
So it's like cash in your pocket today instead of cash in your pocket over the next 12 months, 24 or 36 months. So those are some of the reasons why we just really haven't, it's never really gotten hold. It was more, to me, it was more buzzwords.
Yes.
And there are circumstances where it works.
Right.
But when something's publicized and people talk about it a lot. They all make it sound like, oh, it's good for everybody. But it's like most things in our business. It'll be good for somebody.
Right.
It's there. It's another tool to be used. That's going to be good for somebody. It's something to keep in mind, for another option for someone.
Yeah. So what that makes me think, gosh, that went really loud.
It did.
What that makes me think is it's super important for your agent and your lender and the buyer all to be in communication and talking together, figuring out what the best plan is.
Absolutely.
So because what might be, let me see if I can just turn that down a little bit. I don't know. What might be good in one situation is definitely not good in another situation.
Correct. Yeah, there's no one size fits all. It doesn't work in our business.
Right. So what are some other big mistakes or myths, common misconceptions that buyers have right now?
It's still a couple of them. So a big one is there's still a lot of people that think you really want to strive for 20% down.
Yes.
First-time buyers can buy a house on a conventional mortgage with as little as 3% down. VA and USDA rural development are 0 down. With USDA rural development, it has to be in a more rural area. But believe it or not, a lot of areas around here are considered rural. Dexter is still considered rural.
Right.
Ann Arbor is not. Parts of Ypsilanti Township are considered rural. So somebody could go into Ypsilanti Township and get 100% financing on a house.
Mm-hmm.
The interest rates on government loans are better than conventional mortgages. So they can get a phenomenal interest rate, super low mortgage insurance, and get a loan like that. No reason to think that you need to wait and save 20%, because while you're saving 20%, that house is going up in price.
Right.
It's the same discussion we have with interest rates.
Mm-hmm.
People, I'm not going to buy now. Interest rates are too high. If you can afford to buy now, you buy now.
Right.
When is the right time to buy a house? Yesterday.
Yes.
When is the second best time? Today.
Yes. Mm-hmm.
And that's not. I've seen it in my whole life.
Right.
I wish I never sold my first house. Like, I wish I would have held on to the first house instead of selling it, because that house that I sold for 160 is now worth 350.
Right.
30 years later.
Right. Right. And then you mentioned something. You have buyers that say, "I'm going to wait till the interest rate goes down," and like you said, if they wait another year, that house is likely increased in value. And so what their payment would have been with the lower, potentially lower interest rate, they may or may not be able to afford that house.
Right. With the increase in house, especially 2020, 2021, what happened to house prices. But if you even just factor a 5% increase in house prices from one year to the next, that's relatively reasonable to say a house is going to go up in value 5% from one year to the next.
Right.
Waiting for that interest rate, that lower interest rate, is going to be just about negated by that increase in the purchase price of the house.
Right.
So it is better to buy now what you can afford,
Mm-hmm.
knowing that if rates, I never promise they're going to drop, but if rates drop in the future, you can always refinance and get that lower rate.
Right.
So you can have the best of both worlds. You got the best price, because the best price is going to be today,
Mm-hmm.
and you got the best rate, which is going to be in the future.
Yeah, exactly. So if you have buyers who are thinking about buying in the near future, what would you tell them to get ready? So maybe they're going to buy, they're thinking they're going to buy in the spring, and they're trying to get all their ducks in a row ready to go. What should they do?
Call us today.
Okay.
Call, email, text. They should get in front of a lender, have a lender look at their situation as soon as possible. I mean, if you think you're going to buy a house in the next year, 2 years, it doesn't matter. I've got clients that I've been working with for 2 or 3 years, and they still haven't bought a house. There was a long time where they were not competitive, so they couldn't buy a house. I'm actually super busy right now. Even though the market has slowed down, I'm really busy because I'm keeping in contact with these people from 2 or 3 years ago,
Right.
and making sure that I'm still answering all their questions. They feel free to call me. So the earlier you get in front of a lender, the more prepared you are. You don't want to be, hey, we're going to go look at open houses this weekend, and then you see the house, and they're like, okay, best offers due by 6 p.m. tonight, and you've got 12 hours or less to get a pre-approval letter.
Right.
You don't want to be in that situation because you haven't been educated, you haven't seen the worksheets, ease into the process. That's one of the reasons that we only do a soft credit check when people apply.
Right.
There's a lot of people, one of the questions they ask when they call is, are you going to do a hard credit check? Whether their credit's good or bad, it doesn't make any difference. There's a bad feeling when people do that hard credit check. People don't want a hard credit check.
Right.
So we started, and it's not really that huge of a deal. It can be for some people, so it's best to avoid it. But we only do a soft credit check because that's what people want. It doesn't show up on your credit report as an inquiry, and it allows us to start to have that conversation with people, show them what they can qualify for without doing that hard credit check, and it just makes people at ease knowing that a hard credit check's not getting done. So it doesn't hurt to get in front of a loan officer 6 months, a year in advance.
Okay.
Fine. You'll know how much more money you have to save if you need to save more. Sometimes it can be a difference of a quarter point in interest rate between a 740 and a 780 credit score. And the only thing you need to do is pay down a couple of credit cards over the next 2 or 3 months
Right.
to boost that score and save that quarter point in interest rate.
Yeah.
So the sooner you get in front of us, the more we can advise people on some of the best things, some of the tips we've picked up along the way to make sure you're getting the best interest rate down the road, make sure you're prepared for the cash to close, the payment, make sure you're in the right price range,
Yeah.
all that stuff.
So if somebody comes to you and let's say they do have they have some credit cards to pay off, or let's say they made a late payment on something and that shows up on their credit report, can you then look at that and say, if you do this, this, and this,
Mhm.
in a few months' time, you're going to be in a better position to buy then?
Yeah. So with credit cards and paying off debt in general, we have a system that will tell us approximately how many points they're going to get. So we can figure that out. Unfortunately, with late payments, there's not much they can do.
Mm-hmm.
Time is their friend there. It's worse to go late on something than to have a high credit card balance, because a high credit card balance you can pay down.
Right.
But once you go late, that's a mark, and
Right.
you can ask the lender to whoever that late is with. You can ask them to remove it.
Mm-hmm.
Sometimes they will, sometimes they won't. You can also dispute it with credit bureaus, and when you dispute it, sometimes that'll hide it for a little bit.
Yeah.
But it'll be factored into your score again eventually once they come back and say, yeah, that is legitimate. So there are things that they can try to do to get rid of that. We've got a couple of different services that we'll recommend when people need serious credit repair. That will help them along the way. I let the professionals do that stuff. I can help with the little stuff, the tweaks.
Right.
But total repair isn't something that we're into.
Yeah, I know. I forgot once to pay my mortgage, and it definitely showed up. It showed up on my. I didn't completely forget.
Yeah.
Something got changed on the amount, and I thought I'd paid it all for the month, and I hadn't. And
Yeah.
basically, I just had to wait for a certain length of time for it to fall.
7 years.
Oh, okay.
7 years is the fall off.
Oh, was it really?
Yeah, but as time goes on and you're making all these good payments on top of one bad,
Okay.
one mistake, within a year, 2 years, I mean, it almost means nothing
Okay.
within a couple of years because you've got all these other payments, and there's lots of other credit tips. Don't close your credit cards.
Right.
You got to use your credit cards.
Yeah.
Don't use them to the limit.
Right.
But if you use them, so one of the tips I give a lot of people that don't want to use credit cards or have just paid off their credit cards is like, no, I'm just not going to use any credit cards. Do yourself a favor. You got to have a good credit score to get a good mortgage. Put Netflix on one credit card and put it on auto pay with your bank.
Yeah.
So Netflix charges the card. It goes and it shows up on that you owe $20, whatever Netflix is a month.
Right.
They'll report that you owe $20 that month, and then they will pull, when you put it on auto pay, they'll pull that $20 out of your bank account.
Right.
Then you just leave the credit card in the drawer and it's working for you, and you're not doing anything.
Right.
You're just letting it go. And it's a great way to build credit and make sure you're getting the best credit score possible.
Yeah. Oftentimes people think credit is a bad thing, or having debt or a credit card is a bad thing, but you do have to have some amount of credit and some credit history in order to.
It's a tool.
Yeah, exactly.
It's a tool to get the best credit, to get the best interest rate on a mortgage. And if you ever are in dire straits and you need to borrow money, it's good to have that there. Yeah.
Yeah, it is an option. So before we wrap up today, I want to ask you a couple of questions just to kind of get to know you a little bit better. Tea or coffee?
Well, I like both,
Okay.
but I drink coffee. One cup of coffee every morning is just all I have. I
That's
don't. I
it.
don't. Just one cup.
Just
I'm
one.
trying not to do too much caffeine
Oh,
and
good for you.
too much of that. Yeah.
All
Yeah.
right. If you were going to pick a place to visit in Washtenaw County, somewhere that you love to go, it could be a restaurant, it could be something fun to do. Where would you go?
Well, I'm gonna give a plug here. I love nights.
Oh, okay. All right. What would you love to order?
Well, last night I had a turkey Reuben with bacon on it.
All right.
Really, yeah. I'm partial. I go there once a week. I've been going there once a week for 20 some years. So sometimes twice a week. The original.
Okay. All right.
Yeah, yeah, over on Dexter. Yeah, I don't get downtown too much. I like to park in the parking lot and walk in instead of the structure of the street and walk.
Yeah, it's
Yeah.
much easier.
Yeah.
And then your dream vacation, what would that look like?
My wife and I hardly ever go to the same place twice. We only take one or two little vacations a year, and that's recent. I think our goal would be Scotland, Ireland, England.
Okay.
That's where our families are from. That's where my heritage is. So I would love to go over there. It's funny because two of my kids have been over there already, and I have not. So that I think that's a bucket list item to travel over there.
All right. Well, if you ever decide to do that, I can definitely give you some tips.
I bet you can.
So, if anybody wants to get in touch with you, if they have any mortgage questions, what's the best way to do that?
Email or text or phone call.
Okay.
They can go to my website. All the information is on my website, along with hundreds and hundreds of 5-star reviews from Google and places like that. The website is www.mylendermark.com. That's Mark with a K, so it's really easy. Mylendermark.com. All the information's on there.
All right. Sounds great. Well, thank you very much for joining us today. My name is Diane Crouch, and thank you for listening to the LIVgreat Podcast. And join us again soon for our next episode. And have a great day.
Thanks, Diane.
Thanks. Bye.
Bye.